Stop. Before you buy that high-paying stock, you need to hear this: a high yield like 10% or 12% is often a trap. It usually means the stock price is crashing because the company's in trouble. Check the payout ratio. If a company's paying out everything they earn, they can't grow. That's a dying tree. Stick to the kings. Companies with 50 years of growth are the only ones you can trust with your future. So, how do you turn a few coins into a full-blown money tree? It's called DRIP, Dividend Reinvestment Plan. Instead of spending your dividends, you automatically use them to buy more shares of the same company. It's like planting new seeds every time you get paid. This creates a snowball effect. More shares mean more dividends, which means even more shares, compounding your wealth year after year. It's the ultimate long-game strategy for passive income. Don't chase the high-yield trap. Build a forest of consistent, growing dividends instead. If you want to grow your financial future, hit that subscribe button.